One of the most dangerous things about bookkeeping mistakes is that they usually don't look like mistakes. They look normal. The revenue hits the bank, the expenses are categorized, the reports are there, but behind the scenes, things can be missing, duplicated, or posted to the wrong place. And if that's happening, you really can't trust your financials. In this video, I'm going to show you some of the most common bookkeeping mistakes that small business owners make. First, the reconciliation mistakes that make business owners think their books match their bank when transactions are actually missing. Second, how getting paid through things like Venmo or personal accounts can quietly leave revenue completely off your books. And third, the biggest misunderstanding about accounting software, why QuickBooks isn't just categorizing transactions and what's actually happening in the background that can create major reporting problems. A lot of business owners treat accounting software like it's a budgeting app. It's really not. Money comes in, they mark it as income. Money goes out, they categorize it as rent, supplies, or food. It feels simple. But what most don't realize is that every time you record a transaction, two things are actually happening in the background. For example, if you record a meal expense, the software isn't just labeling it. It's creating an accounting entry. Meals expense increases, cash decreases. That's called double entry accounting, and it's the reason your financial reports work. But if you don't understand that system, it becomes very easy to create mistakes that slowly make the financial reports less and less reliable. One of the most common bookkeeping mistakes I see happens during bank reconciliations. A business owner opens the reconciliation screen, they see the difference says zero, they assume everything must be correct. But that's not always what's actually happening. What often occurs is that not every transaction was included in the reconciliation. Some transactions might not have been selected, or they were missed entirely. So technically the numbers balance, but the reconciliation isn't actually complete. And when that happens, it creates a disconnect between the bank and the accounting records. At first, it may not seem like a big problem. The reports still generate, the numbers look reasonable. But over time, those missing transactions can start to create bigger discrepancies. Eventually, the bank balance in the book stops matching the real bank account, and by that point, the mistakes might be months old. And that's where things become difficult, because now you're trying to trace a problem back through hundreds of transactions just to find where things went wrong. The key takeaway here is this. A reconciliation isn't finished just because the screen shows zero. It's finished when every transaction from the bank statement is properly accounted for in the books. Another common bookkeeping issue happens when business owners get paid outside of the main business account. You'll hear things like, I get paid through Venmo for some of my jobs. That client paid my personal account. At first, it doesn't seem like a big deal. The business still received the money. But from a bookkeeping standpoint, if that never gets recorded in the accounting system, it doesn't exist in the financials, which means the profit and loss statement is now incomplete. The business might have actually earned more revenue than what the reports show because those payments never made it into the books. The numbers no longer reflect what's really happening in the business. And this creates problems in two directions. First, the financial reports become unreliable. If revenue is missing, you can't accurately measure profitability. Second, it can create tax issues later because income is still income regardless of which account it was paid to. So even if the payment came through a Venmo or a personal account, it still needs to be recorded properly in the business books. Otherwise, you're looking at financial reports that are only showing part of the picture. This mistake really comes from one big misunderstanding about how accounting software actually works. A lot of business owners treat QuickBooks like it's just a place to label transactions. Money goes out, categorize it as rent, supplies, meals, whatever it was, and then on the surface, that's what it looks like you're doing. But behind the scenes, something else is happening. Every time you record a transaction in accounting software, two accounts are being affected. For example, if you record a $50 meal expense using your debit card, the system isn't just tagging it as meals. What's actually happening in the background is an accounting entry. Those background entries can start creating problems in the reports. This is why things start to get confusing. When credit cards get mixed up, the wrong bank account gets selected, transactions are entered manually, then also imported in the bank feed. Because if you don't understand what's happening on the accounting side of those entries, it becomes extremely difficult to diagnose those problems later. And that's why many business owners reach a point where they feel like the numbers just don't make sense anymore. Another bookkeeping mistake I see quite often involves large purchases like vehicles, equipment, or machinery. Sometimes a business owner will finance a vehicle, buy equipment with a loan, or write a large check for something the business needs. But because the purchase was financed, or because it doesn't feel like a normal expense, it never actually gets recorded properly in the accounting system. From an accounting standpoint, two things happen when a purchase was made. First, the business receives an asset. Second, the business took on a loan or used cash to pay for it. If that asset never gets recorded, it creates two problems in the financials. The first problem is that the balance sheet undervalues the business because the asset isn't listed even though the business owns it. The second problem is that the business may miss important tax deductions because assets like equipment and vehicles are often depreciated over time. So even if that purchase was financed or paid through a loan, it still needs to be recorded properly on the books. Otherwise, the financial statements aren't showing the full picture of what the business actually owns. Most bookkeeping mistakes don't happen because business owners are careless or bad with their numbers. They happen because accounting software hides what's really happening in the background. On the surface, it feels simple. Money comes in, money goes out, categorize the transaction and move on. But every one of those clicks is affecting multiple accounts, ultimately shaping the financial reports that you rely on to understand your business. So if something ever feels off in your numbers, margins don't make sense, cash doesn't line up, or the reports just feel confusing, it's often not because the business is broken. It's usually because something small in the bookkeeping process isn't being recorded the way that it should be. And once those issues get cleaned up, the numbers usually start to tell a much clearer story about how the business is actually performing.